Hello traders, this is Ben, and I'm here to talk about some of my very favorite tools that I use to trade the markets. We're looking at tradingview.com, which is the online freeware program that I use to do all my technical analysis and charting. And I'm gonna do a series of videos that looks at some of my favorite tools, indicators and overlays that you can use to find an edge in the markets. If you like this video, please go ahead and subscribe. You'll get notified when I upload more content that will be similar in the near future. The first tool we're going to look at is something called a range filter. This is available on TradingView under the public library. It was uploaded by a trader named Donovan Wall and can be found here under indicators and strategies. In the search box, search for range filter, and you'll see it here, DW. The range filter is based on two mathematical concepts. The first one is normal distribution, which for anyone who's taken a statistics class may remember involves finding the mean or the average value and the standard deviation, or how much the information that you are looking at deviates, the volatility, if you will, of the instrument that you're trading. In this case, I'm using a 15 period mean. So this green and pink line is the average price based on the previous 15 closing prices of each candle. So it can be for any period. In this case, we're looking at the Apple hourly chart. So here at 129.58 is the mean price over the previous 15 hours. If I were to look at the daily chart, we'd get a mean price here of 128.62, and that is the mean price over the previous 15 days. So that line alone is quite valuable. We'll talk about that in a minute. The other piece of information that this tool offers is a range from this upper green line to the lower red line. And what, in this case, that's showing is over the previous 15 periods, the last 15 candles, where was a proportion of the trades? Where did they occur? What range did they occur? Now, there are settings that you can customize. For instance, if you wanted to use one standard deviation for your range, you would be able to see where basically 68.2% of the trades over the last 15 periods occurred. So, for instance, currently we have this range here would be the range of the last 68.2% of trades. Anything that happened below that or above that is considered a 1 sigma event, or would have the probability of happening either 1 standard deviation or -1 standard deviation of the time. Now, the standard way to use this tool, and the way I personally use it, is utilizing a Fibonacci number, which is just a number that is a naturally occurring phenomenon where you take two consecutive numbers and sum them together. So eventually, one of those numbers is 2.618. Happens to be an important Fibonacci number, and in this case, it's very useful to be able to see the range that price may move based on the previous 15 periods. And in this case, we're seeing about 96% of trades. So within the last 15 candles, if assuming that price is normally distributed with the majority of trades happening near the mean, you're going to get 96% of trades happening inside of this cloud here between the red lower line and the green upper line. The reason that's really helpful is, first of all, you can right away see which side of the market is in control. For instance, back here in October of 2019, by identifying that the majority of candles remain above the mean, and when they come back to test the mean, they find buyers. You can see here we didn't even test below it at all. Here again, we didn't test below it at all. When we do test below the mean, we find buyers. And again, the majority of trades are happening on the green side of the mean line. Now, if you look where trades occurred above the green line, generally you will have some type of a pullback. But keep in mind, it does not necessarily mean the trend is over. Um, Oftentimes, it just means the price action got a little bit a little bit hot, overbought, if you will, and needs a little rest. Then it can continue. Sometimes what you'll get after that test above the green line in a bull market is again, test of the mean price. And other times you will see a price above the green line followed by a failure of the mean price line. So something like this is much more bearish than this, because in this case we got buyers near the mean, just like this one. Whereas here, we found sellers under the mean. This was following a gap in price overnight. But you can see that when we are bearish, the majority of trades are occurring below the mean price. And again, when we get down below the red line, we generally find responsive buyers. And the reason is because those buyers are aware that 96% of the previous 15 days have traded higher. So you can use this to identify areas that are bearish and areas that are bullish. You can also use it to find zones that are consolidation zones. For instance, when the mean price line is not being respected on either side. This is a good example from September 2020 until it would be, I mean, honestly, still currently, you've got a situation where you were in a bullish market where we were generally respecting the median price line, finding buyers below it before getting underneath the red line. Then we got above the green line and found sellers, again, which is totally natural. But when we fell to the mean price, we once again found sellers, and the price fell below the red line, meaning that again 96% of prices of trades occurred above this price. Buyers, short-term speculative buyers, will show up here, but it does not necessarily mean that we're going back to the top. It could instead reject off of the median price and continue lower, or do exactly what it did here, where it just doesn't even seem to notice the mean price. It just goes over it, under it, over it, under it, over it. And this is a good example of consolidation. The other thing that can show you that you're in consolidation is that the cloud itself is narrowing. You can see here we were much wider than here. And generally, when the cloud is narrowing, price is tightening, and eventually that tightening action of price results in a breakout, either to the upside or possibly to the downside. So these are important things to keep in mind, and it's a good way to start building a strategy, especially if you are a trend following trader. So for instance, if you prefer to buy dips in bull markets, but don't make money when price generally goes sideways or falls over a period of time, you would be looking for entering trades on pullbacks to the median price line when the majority of candles stay in the green area, and you'd avoid buying when you're above the green zone, and certainly not be looking to trade anything where you're either staying underneath the median price in the red zone, or are not respecting the median price at all. which would again signal a rest period. This is just one of the tools that I use to identify who is in control of price action at any given time, and to help filter out some impulsive entries where I might think, such as up here, that I'm missing out on a bullish move after, maybe missing this gap. But once I take a look at this tool, I realize I am paying way too much for this stock, because 96% of the time in the last 15 days, 96% of traders have actually gotten in lower than this point. So I would want to wait. And again, we would then see that the range, that the median price does not hold. So hopefully this was helpful. I'll try to upload a few of my other very favorite tools, and I will talk to you guys then. Good luck, stay green, and trade responsibly.